Thanks for joining us today, everyone. We've got a great crowd, and we're very excited about today's webinar. I'm Kevin Gully, the Chief Product Officer with Truelytics, and today we're going to be talking about mergers and acquisitions in the financial advisory market. And we're going to dig into how to begin with the end in mind when considering selling or arranging for the succession of your practice. I'm pleased to be joined today by two experts in the field. First, attorney Larry Gennari. Larry is a finance and transactional lawyer at Gennari Aronson LLP, a Boston-based law firm. He is also an adjunct professor at Boston College School of Law. Larry will be walking us through some best practices to take into consideration when going through the M&A process. Second, we're joined today by Terry Mullen, the founder and CEO of Truelytics, who will be reviewing how financial advisors can strengthen their businesses by thinking like a CEO, a topic very relevant to the M&A discussion as it speaks to maximizing a business's value. Terry's background prior to Truelytics includes a successful 30-year career in financial services distribution as a senior executive with AIG, Lincoln Financial, and Sun Life, amongst others. He's going to be providing us with a demonstration also of the Truelytics software as a service platform for helping advisors value, benchmark, and improve their businesses. But before we get started, a couple of quick administrative items. First, we're going to leave some time for Q&A at the end of today's session, so feel free to ask questions in the questions section of your GoToWebinar app. Second, keep your eyes peeled for an invitation for our next webinar coming up towards the end of May, shaping up to be a great one. And finally, today's session is being recorded, and we'll make it available for your review after the session, so keep your eyes out for that. But for now, I'd like to hand it over to Larry Gennari to kick things off and to walk us through how to start at the end with mergers and acquisitions. So take it away, Larry.
Kevin, thank you so much. I'm delighted to be here with all of you. This is a really timely topic. It's a great time of year to be doing this. And we all know from what we've read that 2017 is going to continue to be a year marked by robust activity in the M&A space, particularly in the financial services space. So we call it Start at the End because what we're trying to focus on is steps that you can take now for a profitable exit strategy later. So we'll go through some of these slides with some general points that many of you probably have thought about but not revisited in recent years. So the first item we'll talk through is understanding the sales process. So the sales process is not that complicated, but does bear repeating. The first step is to understand the perspective. We call this sort of start at the end. Perspective's critical. Why are you selling, and what do the buyers want? We all know that perspective is critical in understanding the sales process. That is, you have your own business. What you have to understand first and foremost is what other people might pay for it and how they might think about it. There's always two numbers in mind for a seller, what number they want and what the market will bear. And every step that you take enhances your possibility for those numbers converging and getting a deal. So perspective is critical. Process. There's a beginning, a middle, and an end. The beginning is really about discussions with other potential players, non-disclosures, due diligence, and perhaps a letter of understanding or a letter of intent or a term sheet. The middle, drafting the agreement, and of course the end is the close. Overall timing for a lot of these processes, a lot of these sales processes, is 3 to 6 months. I tell people that purchasers, particularly in the financial services space, might be one of sort of two kinds. Financial, a larger player trying to consolidate other advisory businesses, or strategic, someone you might even know, someone who you've competed with, somebody who might understand your business and advantage and contacts better than anyone else. Those folks I'd call strategics, and they tend to pay more because of the potential synergies that they see and because of the understanding of the business that they already have. Once you understand the sales process, the next key is really to assemble a team of advisors. And of course, I don't mean that in the industry sense of other advisors. I mean it in the sense of pulling together a team of people who really want you to be successful and who understand your business and your goals. That could be a board of informal advisors, or a board of formal directors. It should be your accountant, not so much your bookkeeper or this person who just does your taxes, but someone who's a trusted advisor and understands the strategic reasons behind the decisions you're making. Should include your lawyer, not so much a real estate lawyer and estate planner, although they may be trusted advisors as well. This really ought to be somebody who understands M&A and who has expertise and has done these kinds of transactions. It's a very different dynamic and a very different rhythm to these kinds of transactions, so you want someone who's a repeat player. And lastly, assembling a team of advisors is probably an investment banker, and more on that in a bit. So the next thing you ought to do is make sure you assemble the very best tools. And by tools, I mean the things that will help you inform yourself about what others might be considering most important about your business. You can think about things that are online, industry white papers, to learn about industry trends on hiring, regulation, or tax changes. But you also want to do some internal analysis. More from Terry Mullen on that later, but the Truelytics tool can truly give you a sense of how your business is doing when you compare to the competition and how it might look to a potential buyer. That ties in to the next slide, which really emphasizes doing diligence on your own business. This is the conversation about perspective continued. You really have to think about how someone else is going to view your business. I liken this a lot to the real estate transactions that so many of us go through when we're trying to sell our condo or a house. One of the first things that an experienced agent will tell you to do is change the way you think about the place where you live, the place you do business. How is someone walking into this going to be thinking about it? For real estate, that might mean painting the walls white or moving furniture around or removing knickknacks and personal photos. But for a business like yours, I think it involves taking stock of both internal and external diligence on your own business. Internal, that means things like your operating agreement. What does it say about succession planning? What does it say about whose decision making will be impacted by this kind of transaction? Who has to weigh in on the decision to sell the company? What promises have been made in that operating agreement? Are there non-solicits or non-competes in that very operating agreement? If not, you might want to think about getting that in order. Other things to think about in terms of internal due diligence: accounting. How are your books going to look to someone else as they start diligence? Are there chargebacks? Are there personal expenses and bills that are run through the business? Are there marketing expenses that you haven't thought about or categorized that really require review? Personnel changes. How about your hiring and firing? Do you have a personnel challenge or a set of underperformers who you really ought to think about replacing? You ought to do that sooner rather than later because they're going to be part of the package that a buyer sizes up as well. How about contracts for these various personnel? As I said, non-disclosures, IP assignments. Have they helped you develop products? Do they have contact with certain customers? Are there trade secrets? Have any of these folks been promised equity or a piece of the company, either actual equity or some sort of phantom stock, where you're giving someone a promise of a piece of any exit? Those kind of promises, whether they're oral or an email, can be enforceable. And there's nothing like a great purchase price or a successful exit that pulls people out of the woodwork. So I always tell clients who are doing diligence on themselves, really think hard about the kind of incentives that you've promised over the years and whether or not you've fulfilled those promises. Other things to think about internally: do you have any investors? Any other people who are expecting a return? Any lenders? Anyone who's from whom you've borrowed? Those are the kind of things that you want to get in order and think about as you're doing diligence on your own business. Externally, in terms of doing diligence, how about your client relationships? What do your documents look like? What do your basic client contracts look like? Do they contain negative consent? Should they? If you're thinking about a transfer, how easy is it going to be? When someone else is looking at your business, the first thing they're going to zero in on: price, term of the agreement you have with the client, and the assignment provisions, and whether or not you've provided for negative consent. So the time is probably now, if you're thinking about an exit 12, 18, 24 months out, to standardize and normalize some of those contracts so that they look more the same than different. So due diligence on your own business. The next step, once you've done that diligence, is thinking about how you create a competitive process. So when you're selling a particular company, there really are there's two ways to identify buyers. You can do it yourself through serendipity, or you can hire an outside intermediary. I can't tell you the number of times that I've been involved with a seller who says, gee, there's only one logical buyer, someone who's been tracking us for years. I'll just go to them. Well, you can imagine what that negotiation looks like. If there's only one person in the room negotiating with you, or only one person in the game, the price, the terms are going to be dictated largely by them. An intermediary, on the other hand, can create a competitive process, or just as importantly, the illusion of a competitive process. The idea that terms, timing, and the overall purchase price that you're going to get are only going to improve when there are more people in the game. So think about who you might pull together, or who you might pull in as part of your advisory group as a potential investment banker, someone who has sold other businesses, put other businesses together. Many on the Truelytics team have experience in this. How are those folks going to be able to help inform you and what your other alternatives might be? Oftentimes, it's not just one absolute perfect buyer. Usually people can find either better terms or a better buyer through that kind of a competitive process. I tell people, too, make sure you don't talk to somebody who holds themselves out as an intermediary, but really only does this part-time. You really want someone who is credentialed, both with experience, but also registered with both federal and state authorities, as they ought to be. The landscape is littered with folks who consider themselves deal makers, but they're really not. And so if you want this done the right way to create that competitive process, you want to find someone who is adequately experienced and credentialed in that field. The next important thing to think about, and oftentimes it's overlooked as people go into sale mode, is having a plan B. One of the things that you often want to tell folks is you've got to run this parallel path, assuming that you don't sell the company. That means a few things. It means that if the business isn't profitable and you've got to sell in 3 to 6 months, that's a challenge. So plan your business, make the changes you need to so you don't run out of cash and so that you're not a seller on your knees. You really have to consider, if this process doesn't work, if those two numbers, what I want for the business and what the market will present for this business, don't align, I'm going to run this. So you got to have that plan B. And that means that you got to be careful through this process as part of that plan B. The first is, again, don't run out of cash or alternatives. Don't allow the diligence to proceed so that the purchase is a foregone conclusion. What does that mean? Most sellers are pretty careful about staging due diligence from a potential buyer. They don't let buyers come in and meet with, talk with their top clients unless and until they are either at the finish line or pretty darn close. Other people who've done that in the past, allowed full-blown due diligence from the beginning, often find themselves having to do a deal now that clients have spoken to a potential buyer and like the prospect of a deal. You can only imagine what the terms and conditions are going to look like should the potential buyer decide that they want to pay less rather than more for your business. And to that end, don't assume that this kind of a transaction that started with a term sheet is going to end with that term sheet. You've got to be quite vigilant about this. And that includes making sure that a potential buyer understands as much about your business, at least the basic parameters, as possible. But it also involves assuming that you as a business leader are not going to assume that the transaction solves internal or personnel problems that you'd just as soon pass on to someone else. They'll figure it out. And more importantly, as we'll talk about in trouble spots in a moment, deals don't get done and deals can be derailed when some of these problems that a business has ignored for a while rear their ugly head during a sales process. And most importantly, don't omit, in terms of running this parallel process in Plan B, don't do things with your client base that, or not do things with your client base that you otherwise wouldn't. So for example, if you need to raise prices, if you need to change services, if you need to change a model for a particular kind or level of service, do it now. Don't wait until, and don't assume that the buyer is going to either do that or solve a problem that you haven't dealt with already. Once you've done all of these, once you've taken all of these steps, you need to understand the basic structures for these kind of transactions in the financial services space. And they really are only a couple. One could be the purchase of the assets under management. That is, someone comes in and they really only want those relationships. They want either the products that they're selling or the people they're selling to are so complementary that they're effectively buying the advisory business for its, quote, assets. The other structure involves more of a stock sale, and then contemplates that the owner-operator of the advisory business, in many cases, is going to stick around for a while to make sure that the assets under management stay and that the clients are happy. So understand from the beginning, in the get-go, how long you might have to stay and what the terms for that might look like. And the terms for that might involve either an earnout, that is some of the purchase price up front, the rest of it on the back end, depending on how many assets stay and grow with the business, or a set price for the business together with some sort of employment package for somebody who stays on or for some of the team members who stay on. Those are really important considerations, and they factor into the basic structure for this kind of a transaction. So understand at the get-go why they want to buy your business. And don't assume you know. You should ask. Button down the deal points. Here, I see that far too many deals get far too down the road and along without the parties coming to a basic understanding about two of the most fundamental principles of any M&A transaction: how much you're being paid for the business and how you might have to give it back. So with the purchase price, understand how it's calculated and what the buyer is expecting to pay in cash, over time, in a note, going forward. The other piece is indemnity, how you might have to give some of this back. What are the carve-backs? Typically, when you sell a business, you have to give representations and warranties about the state of the business, the state of your client relationships, and whether or not you've had any problems, litigation, personnel, tax. You want to make sure that, of course, you've scrubbed all of those representations and that what you're selling, your representations about what you're selling, are reflected in your reps and warranties. There'll be a carve-back for that if you're wrong or if there's a breach. The lawyer can tell you how to best approach those and how to qualify and modify some of those reps and warranties. Key points in any kind of indemnity. How long do they survive? Should these representation and warranties survive for 1 audit cycle, 2, 5, 7? All of this is negotiable. Is there a cap on any particular liability? Is some of the money held back? Are some of the representations and warranties considered so fundamental, tax, ERISA, how you've taken care of your people, maybe intellectual property, that they should last for a very long time? All of these are provisions that are pretty standard in an M&A deal, and if they don't come up early on in the form of a term sheet or letter of intent, then they're not going to get, it's not going to necessarily be easier to solve those. They're not going to get better with the age of a deal. So I always tell folks to button down purchase price, indemnity terms, as well as employment agreements. You want to know who the buyer, if they do, who the buyer wants to take with them and what the terms are going to be. Importantly, people want to know what the non-solicitation will look like. Is that of other employees who might leave after the buyer takes over, or is it of actual clients? And if so, what does that look like? And what's the non-compete look like, and how long should that be? At least in Massachusetts, These terms, non-competition provisions, are still enforceable, but they may have to change depending on what legislation evolves from the current session of the Massachusetts legislature. If you're in a place like California or even New York, you really want to check local law and make sure that you understand what the scope of a non-compete can be. You will find that the scope of a non-disclosure can in fact be even more powerful than the scope of a non-compete, and might actually be more of what you want, more of what the buyer wants, more of what you want to make sure you have in place as a seller than a non-compete. And finally, a deal point to button down is exclusivity. How long are you going to give the potential buyer to negotiate this deal? As I said, typical deal process can be 3 to 6 months depending on the diligence. Could be 1 month depending on how well the buyer and the seller know one another. Oftentimes, the buyer wants to button down this seller so that they can only sell to this particular buyer, and they'll ask for what's called a term of exclusivity. That is, for 30, 60, 90 days, maybe even longer, you, the seller, shall not talk with, negotiate, or even respond to anybody else who might come into the picture and want to buy your business. That may not matter for 30 days, but it sure will matter to a potential seller if it's longer rather than shorter. So exclusivity will be a term that you want to button down as part of a term sheet. So as part of the overall process, try to get as much information as you can from a potential buyer about purchase price, indemnity, and personnel issues. Who's going with the company, and what will the terms be? The next step is typically to prepare for initial negotiations. Diligence will continue typically between the buyer and the seller as they're negotiating the fine details of the purchase and sale agreement. As you're preparing, one of the things that's going to be most critical is who needs to know on your team. The buyer will undoubtedly have questions for the finance folks, HR, and actually the people who run some of the most important client relationships at the business. When you need to involve them, when you allow the seller to actually speak to them, varies from deal to deal, and you want to be very, very careful as you prepare for these kind of negotiations. When I represent a seller, I usually tell them, let's try to put these off for as long as we possibly can, because they really can't be unwound. It might be that a business owner is testing the waters, not quite committed, not quite more than 50% sold that their company can go to the highest bidder, and therefore they want to be very sensitive about who knows on their internal team and when. Tax issues. One of the things in preparing for initial negotiations is to understand your own tax profile. Will it help to stretch buyer payments over years, over a period of years, so you can get installment sale treatment? Or would it be better in this particular tax year for you to get all of the purchase price up front? How much ought to be allocated to a non-solicit or a non-compete? All of these are great questions as you prepare for initial negotiations, but it's hard for you to know what you want unless you've huddled with your team of advisors, your tax accountant, and your lawyer to outline some of these basic terms so that when you enter into negotiations, you have a pretty good set or range of where you want to settle, a range of possible alternatives for yourself that make good sense to you. And of course, as you prepare for these initial negotiations and people on your team learn about your the potential sale process, you want to make sure that you button them down with employment agreements and non-competes and non-disclosures so that as you enter into negotiations, they don't fall apart because you haven't thought about that. One of the last items is really to prepare for the inevitable. There will be tough spots along the way in negotiations. Things that often pop up are key personnel issues that people haven't solved in the past. And that can be things like a promised sale bonus that might be, that might fall on a date between the potential sale and the end of year for the seller's business. You've really got to think about that trouble spot. The investment banker role can be really helpful in smoothing out some of these issues, but also any other issues that arise. So to the extent that you come to an impasse between buyer and seller, the investment banker can often serve as the intermediary, acting as the diplomat between the buyer and the seller trying to get a transaction done. So watch for those trouble spots, get as close as you can, and understand that you can involve your investment banker in some of these decisions. The biggest trouble spot I have found, and one that I'd mention as one of our last points here, is that for the seller, they have to be absolutely engaged. Their engagement will be key to the sale process. If the seller isn't involved in the day-to-day and understanding where diligence is in terms of its status, what the transaction is supposed to look like, and at, frankly, every diligence meeting with a potential buyer, that can be a mistake. Problems can arise from the smallest of issues, and the seller needs to be thoroughly engaged and on top of everything. After all, it's your business, and you want to make sure that it's presented the right way to a potential buyer. So with that, I'm going to turn this over to Terry Mullen, and I'm sure we'll be able to take some of your questions at the end.
Yeah, thanks, Larry. This is Kevin just jumping in real quick. That was fantastic. I actually am not planning on selling a financial advisory firm, but I took about 4 pages of notes, so that was that's a good sign usually. A lot of great information there. I do appreciate that. Before we jump over to Terry to walk us through how to think about your business like a CEO, which is going to be a very interesting conversation because of the information that Larry just laid out for us. I just popped a poll up on the screen. I'd like if you folks could take a couple of seconds just to click on the answer to the question in the next few years you're most likely to. I would appreciate it, and you know, we'll get a little bit of feedback on that. As I mentioned before, if you have any questions for what Larry has gone through, please feel free to jump into the question section of the GoToMeeting app, and you can go ahead and ask any questions there, and we'll try to get to them at the end of the conversation. I'll give you a few more seconds to give your answers to the poll, and then we'll jump in, and I'll turn this over to Terry so that he can start walking us through how to think about your business like a CEO. So we've got some great response in the poll, and so thank you very much. I'm going to close that, and I'm going to hand it over to you, Terry. You can take it away.
Thank you very much, Kevin, and Larry. Thank you very much for being on, and great content. So now that we talked about M&A and how to think about it, and starting with the end in mind, let's start to think about your business. Since most of you have joined us here today, many of you have joined us here, you're either looking to buy, looking to sell, or maybe just looking to educate yourself on the topic. It's really interesting because the industry statistics tell us that over the next 10 years, 30 to 40% of advisors will retire. That's both self-reported, the number's actually higher than 35%, and industry-wide statistics from the Bureau of Labor. So that means a lot of clients' assets are going to be up for grabs, and it means a lot of businesses are going to be for sale, and making sure your business is a top shelf property is going to be critical, and again, regardless of whether you're looking to buy or sell, being prepared is going to help you regardless of that outcome, and really knowing what to do. Larry alluded to it earlier. Many people start by saying, this is what I want to get for my business. Unfortunately, that's really the wrong way to look at it. The better question is, what will someone else be willing to pay for my business? And what does it have to look like in 1 to 5 years so someone else will find it attractive and we can come to deal terms? And a CEO always starts at the end. They always start at the end and work backwards. So start to think like a CEO would think. What are the characteristics of your business that you and how should it look as you go forward? At Truelytics, we score businesses on their business risk, their client risk, and their market risk, and look at the stability of those areas. So under business stability, there are things like the strength and depth of the management team, continuity plans and succession plans. What has the growth rate been historically? There are a lot of areas that we look at to decide and to score from a risk standpoint How stable is that business? Second, we look at their client stability. What's the AUM? What's the client base look like? Their age? How long have they been with you? What type of relationship with them do you have? How often are you interacting with them? Are you working with the children, knowing that a very, very significant number of assets will walk off the books if you don't have a relationship with the kids when the parents die? And then your market stability. What is your mix of business? Are you still doing a lot of commission type business, or have you moved to manage money and fee only? Do you have a diversified business, or is it going to be very heavily tied to one area or the other? All of these things are going to be important when you look from a seller's or from a buyer's standpoint on how much they're going to be willing to pay for that business. So understanding it today really, really is critical, and taking the steps once you know that to improve upon that. The other is that the CEO is going to want to look at, as well as a potential buyer, is how does it compare to others in the industry and others that may be for sale? How do you look against certain areas? So you can benchmark your business very easily, and many of you do. But some of the places that you may want to look at is how many clients or assets do you have per advisor or staff? What is your client acquisition strategy? How much does it cost for you to acquire a new client? What is your revenue versus AUM? Your expense ratios. Again, do you have a relationship with the next generation? These are all areas that you can benchmark against, and then look out and benchmark it against others of similar size and similar geographies. But that's going to be important as someone is looking at whether they're going to buy one business versus another, is how it compares. And getting yours to be the most attractive will obviously provide for the best value down the road. And that leads to the question of, what is your business worth? But more importantly, maybe how much could it be worth if I did certain things, and how do I get there? Well, Larry said early to start with a self-diagnostic. I was a senior executive. I ran Sun Life's U.S. distribution as well as the international high net worth business. And every year we went through an exercise that was basically, we bought ourselves. We went through a process where we bought the business that we were running, so we could look at it and understand what it would be like to a potential buyer, which was incredibly helpful when we ultimately did sell that business. But it's really critical to know, and all of you know this, that to improve on anything, you need to have a starting point or a baseline. And that's what Truelytics offers. It's an easy online tool that you can get a diagnostic, a self-diagnostic. So when you go to the Truelytics website, you can easily and inexpensively gather the data and information that you need to perform a self-assessment. I'll walk you quickly through, if you were to sign up, and there is a free version that you can go in and fill out all of the information and get your score. We ask questions on your firm, your ownership, your advisors, your clients' processes, your revenues, and your financials. All things that are going to be important to not only a self-diagnostic, but also to a potential transaction. It will then give you your Truelytics evaluation on a discounted cash flow basis, and a scorecard on your business, client, and market stability that also shows the potential impact that you're leaving on the table because of that score. It does include an emergency continuity profile. What happens if you get hit by a bus? You can go in and work with a local advisor or someone you know to make sure that you have an arrangement with them in case something very unfortunate were to happen. But that's going to be critical as you think about looking at your business. I'll briefly go through. The questionnaire will take somewhere around 20 to 25 minutes, provided you have the information. But we ask questions around your firm, when you were established, how you're structured, how you were registered with the SEC, how many owners, advisors, professional staff, other staff. We ask information on the owners, how many there are, what their age is, and whether they're an advisor or not. We gather information on your advisors. If there are more than one, you can add as many as you have. And then we get information on your clients. How many clients does the firm have? What's the assets under management? What's my average client age? How many years have they been with me? How many do I add and lose each year? What's my client acquisition strategy? What percentage of my clients do I get through referral sources? What percentage of my AUM is with my top 5 relationships? Do I do institutional business, and what percentage of it is it? Do I have a relationship with the next generation, and how often do I interact with my clients? Processes, do I have them? Do I have continuity plans and succession plans in writing, non-competes, bonus programs, etc., disaster recovery? And then track all of the CRM usage. Again, that's going to get to some of the things in a deal where it will make it either more expensive if the technology doesn't match up, or if you don't have any. Then we get information on your revenues. What is the net revenue? What's the expected growth rate? What percentage of your revenue is recurring each year and reliable? Do you have discretion? And if you do advisory business, what are you charging on your advisory business? And then we get the revenue breakdown by product area. And then the last page that we get information on is your financials. So we collect 5 years of net revenue if you have it, and then the line item breakdown for your expenses with add backs and adjustments that will then lead to a Truelytics score. This is a GPA. Think about it as a cumulative average in college. So this business has a 2.83, little under a B, maybe a C plus for their score. That's going to tell you what the health of the business is, and a discounted cash flow valuation of $3.5 million with the business stability, client stability, and market stability scores. It shows the P&L, the valuation ratios, and then it shows you how we come up with the discount on that on the cash flow and on the business. It provides you with a scorecard which is going to show you where those areas are that you are losing value and where you can improve. I'll just highlight a couple. This is a business that did have succession plans and continuity plans in place, so they had an A, but they don't have non-competes or retention plans. So that is going to take value away as part of those negotiations that Larry was talking about. These are the areas that you're going to start to lose value as you are negotiating with a potential buyer. On the other side, you can see the average client age is 65. That's a negative. These are clients that are now not only most likely in decumulation mode, they're also closer actuarial to the end of their life. So that is going to have an impact on what someone would be willing to pay. Again, this is going to help you from a diagnostic standpoint look at what are the things in the future that I should be doing. Maybe you start to go down the age spectrum and try to bring on younger clients to get that so you have a lower average age of a client. Maybe you're relying too much on referrals. Right here, that's also a C plus, $60,000 potential impact. Diversifying your client acquisition strategy would be critical. This isn't the case here, but maybe you do institutional business. Institutional business, in many cases, will be viewed as a negative because that is business that comes up for renewal. It goes out to bid, and it's typically at lower margins. So again, it gives you a lot of great information that you can now take and see what is it that I have to do to get that to an A. And if I can get all those to an A, I'm going to have a much healthier business at the point that I'm ready to go out and look for a transaction. Or on the other side, if you are looking to buy businesses, it's a great way to understand the health of the business that you're potentially buying and where those gaps could be. We also show you your pro forma. This is taking it out 5 years and how we got to the discounted cash flow number. And we show you on other methodologies as well. So if you want to look at it on a multiple of revenue at a low and a high industry number for this asset type or this asset size, or a multiple of EBITDA or EBOC, you see that as well. So it gives you a very good range of what your business would be worth. again, as Larry mentioned, it's only what the market is willing to pay for it and what a seller is willing to pay for it, or a buyer is willing to pay for it. But it will give you a very, very good starting point. Let me close by just showing you that you can go into the Truelytics site. We have all kinds of things here. There's tons of articles, blogs, information, other web series that are up here. This one will also go up. It's very easy to sign up. You can opt for to test drive it with the free version. You will not get your key performance indicators and the detailed scorecard, but you will get your high-level valuation and score. You can pay, the best value is paying it up front annually, or you can pay month to month with a commitment for at least 12 months. So that is the Truelytics software. Our mission is to help advisors who have been in this business for years get the most out of their business, to start thinking of it like a business, and to use metrics and benchmarking to improve their business. With that, Kevin, I will turn it back over to you, and we can take questions.
All right, terrific. Well, thank you, Terry. That was great. And so, interestingly, I appreciate everybody answering the poll. So to give you a quick overview, we had about 22% of people have said they were interested in buying a financial advisory firm in the next 3 years. 35% said they were interested in selling a financial advisory firm in the next 3 years. So, so a little bit more wiggle room on the buy side, it looks like. And another third of you folks said you weren't planning on doing any of those, but it is an interesting, exciting time in the marketplace. And that leads us to some questions. Thank you, folks, for submitting questions to us. And the first one I want to get to, I guess this will probably, well, it could go to either of you guys, I suppose. But it's, are you seeing more financial as opposed to strategic acquirers in the market nowadays? I don't know if that was something you want to take, Terry, or maybe Larry.
Yeah, I'll take it, and Larry can add. I think there are a lot of strategic buyers out there today, particularly in the RIA space, where we are seeing, you know, firms that are looking to get to scale and buy up businesses. They have the ability to provide services at a greater level than some others. But you know, in order to have that, you need to really have a business that is, you know, that is a business that can be unplugged and plugged in somewhere else, as opposed to just having, you know, a bunch of clients that that you're servicing and really don't have the infrastructure to do that. But there is a lot of activity in the marketplace today, and there are today a lot of people that have raised their hands that you know, are saying they're looking to sell, and even more hands that are saying that they're looking to buy. The challenge is many of the buyers that aren't strategic don't have the capital, the resources, the know-it-all, and how to accomplish those transactions. Larry, any?
Terry, I think that's right, and you touched on this, and it's part of the Truelytics score. But I do think you're going to find a lot more robust activity, particularly at the strategic level, depending on the nature of the assets. You pointed it out. Do you manage the family's money as well as the kids' money? I see a lot more strategic activity. We represent a few advisory firms, and I keep hearing this again and again. First thing people want to understand is what's the nature of your assets, and they want to make sure that the relationships are not only large but deep. So they do want to know, what's your plan for making sure that these relationships stay. Tell me about your relationships with G2 and G3. I'd really like to know that. That, I think, is as important as the dollars under management.
All right, terrific. So, so here's another question. This one may be right up your alley, Larry. How many potential acquirers should someone try to get engaged in a sort of a competitive process for their firm?
Well, it's a great question, Kevin. The easy answer is certainly more than one. Ideally, in these situations, we'll see over the course of a process, non-disclosures go out, depending on the size of the business being sold, anywhere between 3 and 10, from a solicitation of maybe 2 times that. Best to find 5 or under that are really going to be serious, and you start with indications of interest. You do what you can to sharpen those, or that this is why you use an intermediary or a banker, but it really does take only more than one, and I would say to someone who has a logical buyer that they've actually identified, again, either a competitive process or the appearance of a competitive process. You want people to make sure they understand that you have alternatives. Plan B, of course, is always an alternative. That is not doing a transaction, but you always want to make sure they understand that you can actually talk to someone else, and that is as much art as it is science, and that's why I often advise firms to really think about using that intermediary, because a good intermediary can really boost the price. So you only need one. Ideally, the ones that I'm seeing these days, it's 3 to 5, typically not more than that, unless they've really got a nationwide appeal based on the dollars they have under management or the people or the families that they're advising.
Right. That's really interesting. It actually sort of leads into the next question, and maybe this one's right up your alley, Terry, in that the next question is, how are the potential impact scores, or I guess prices, calculated in the scorecard key performance indicators? I'm guessing that has something to do with the size of the firm and things along those lines as well.
Yep, it has to do with the size of the firm, and if you think about it, our scores and the risk premium that we're calculating in the algorithms underneath are how predictable and stable is that cash flow going forward. People aren't buying your business for what it was; they're buying it for what it can be and what it's going to be. So if things like average age, things like your client, if you have relationship with the next generation, if you don't have succession plans or non-competes, those are things that are putting that cash flow that today might be very good at risk. If you had a large reliance of your assets with a couple of clients, you were going to, if you were a buyer, discount that, because the potential to lose 1 or 2 of those would significantly impact that. The amount that it is depends on a couple things. One is the size of the assets and the revenue, because that will have an impact, but it will also be a percentage. In any case, the most that you can lose in any one area of business, client, and market stability would be a total of 5%. And in this industry right now, on a discounted cash flow valuation basis, the industry is looking, or the buyers are looking, to get a 21% return. So that's the baseline, and then you add to that. So the maximum discount would be 36%. But each individual score underneath, it depends on how weighted that is, based on how it would impact the future cash flow.
All right, terrific. So that sort of wraps it up for the questions we had submitted. So it looks like we're going to be able to wrap up a few minutes early today, but we really appreciate everybody joining us. I think this has been a very interesting and insightful conversation. Larry, thanks for your insights on the M&A side of things. Like I said, took a bunch of notes. I'm sure the folks who were sitting in were doing the same. And Terry, thank you for your insights into the Truelytics tool and how that's going to help businesses really focus on their organizations and think like CEOs. Again, this has been Larry Gennari with Gennari Aronson and Terry Mullen, the CEO of Truelytics. And thank you all for joining us today, and we hope to see you at our next webinar. Have a great day.
Thank you.